Let's now quickly revise accounting standard 21, which is consolidated financial statements. First of all, why do we do consolidated financial statements? As per section 129 subsection 3 of Companies Act 2013, every company which is a holding company should mandatorily prepare consolidated financial statements, and the sections what will apply, or the provisions of Companies Act what will apply for preparation of financial statements will mutandis apply to consolidated financial statements also. Quickly, if we look into definition given under section 2 of Companies Act 2013, subsection 46 defines holding company, subsection 87 defines subsidiary company. Section 2 subsection 46 says holding company is a company which has a subsidiary company. Subsidiary company is a company in which the holding company holds more than 50% of the shares with voting rights, or a company controls its board of directors composition. In that case, the company in which more than 50% is held will become subsidiary. The company in which composition of board of directors is controlled will become subsidiary. The company which is controlling will become holding company. And they are supposed to do consolidated financial statements. Why should they do? This is supposed to help in two things. Number one, decision making. Number two, legal compliance. Decision making. Now, if you see holding company's balance sheet, in the balance sheet on the asset side, we'll have investment in subsidiary 80,000 shares. But that 80,000 shares actually gives you control of subsidiary. Instead of writing 80,000 investment, we want to write all the assets of subsidiary, all the liabilities of subsidiary. Though only 80% belongs to me. That 20% of the assets and liabilities of subsidiary, what doesn't belong to me, but I've included it into my financial statements by line addition, I'll represent that as minority interest. The interest in the subsidiary by the people who are not forming majority. The interest in the subsidiary which is held by minority people, that will be liability in my balance sheet. So I take all the assets of my subsidiary and write it in my balance sheet, and not just represent interest in investment. This is because I have control over that company and I don't just have investment in that company. And this is legally also supposed to be compliant. So the objectives are, it helps in decision making as well as in legal compliance. This consolidation need not be done in two circumstances. Number one, the control that I exercised on this company is intended to be temporary. Maybe there is a stock dip, the price of the subsidiary company shares went down. So I went on buying the shares. It was not my subsidiary. I went on buying the shares without even realizing that I became its holding company. And I don't intend to hold it for long term. My intention is not to have control over it. By mistake, I became a holding company. Then I don't have to do consolidation because I don't have intention to continue as a holding company. Second one, I hold more than 50%. I have interest in that company, but the long-term restrictions issued by government are such that I cannot exercise any control over it. I cannot transfer cash from that company to me. I can't do it. There are such restrictions. In such case, though I hold more than 50% over that company, by substance, I don't have control, so I should not do consolidation. That is exclusions. And in the standalone financial statements of the holding company, you actually apply accounting standard 13 investment. However, in the consolidated financial statements only you will apply AS 21. Whatever working notes you do in consolidation are only in consolidated financial statements. Standalone financial statements of holding and subsidiary will continue to be like how it was previously. Understood? Then what and all does the word consolidated financial statements include? It will include balance sheet, statement of profit or loss, cash flow statement, all other significant notes and accounting policies, notes and other significant statements what is required in along with financial statements. Next, there are certain items which are considered in detail in consolidated financial statements like balance sheet and P&L. I'll cover all of those items in a brief. Shall I? To start with consolidated balance sheet, there are certain items which are to be considered in special note. Starting with share capital. Share capital of the holding company will be appearing in the consolidated balance sheet as it is. There's going to be no change. However, subsidiary company's share capital should not be written in holding company's consolidated financial statement because it is holding company who is preparing consolidated financial statements. Subsidiary company share capital sally share certificate mein the certificate name written is subsidiary companies. How can you write subsidiary share capital in holding company share capital? You can't. What you do is subsidiary share capital should be split into how much of it is held by holding company, how much of it is held by minority. Minority is other than majority, that is people other than holding company. And this holding company share and minority companies number of shares that they hold, we need to identify a percentage as to how much percentage does the holding company have, how much percentage does the minority has. This percentage computation is important because reserve analysis is done and the reserves are distributed between holding and minority in that percentage. Later, what I would want you to know is this share capital of subsidiary which is shared to holding, whatever holding company holds, is nominal value of the investment what the holding company has made. This nominal value of the investment made by the holding company will be later compared with book value of investment. In the consolidated balance sheet, share capital of subsidiary company held by holding is liability. It will be adjusted against asset in the balance sheet of the holding company. Investment in subsidiary, they both will be compared. Book value of investment from the asset side of holding company, nominal value of investment from the liability side of subsidiary will be compared. Book value is asset and liability is nominal value. When asset is more, it will turn into goodwill. When liability is more, it will turn into capital reserve. This goodwill or capital reserve is called by another name called as cost of control. Next, this minority share in the share capital, whatever exists, will be kept aside in a table called minority interest. Later, you will assign the pre and post acquisition reserves that belong to minority. Adding them all together, we call it minority interest, which will be later transferred to our consolidated balance sheet on the liability side. Minority interest, what will appear in the balance sheet in the consolidated form, should be after shareholders fund, before non-current liabilities. You write share capital, reserves and surplus, share application money received pending allotment. After that, before you write non-current liabilities, it's a separate line item called minority interest. This minority interest is not there in Schedule 3 format. It is in a special purpose financial statement like consolidation that it will appear. One bonus and very important adjustment to remember when you're dealing with share capital of subsidiary is bonus issue. After the date of acquisition, before the date of consolidation, if the subsidiary company makes bonus issue. I'll repeat. After the date of acquisition, before the date of consolidation, if the subsidiary makes bonus issue, those bonus shares will belong to holding and minority both. Holdings share should be added to nominal value of investment. Subsidiaries minority share should be added to minority interest. Do you guys get this? Very nice. And in this case, remember the investment book value in the asset side of the holding company will not include such bonus issue. Question number 9 from our study material, ICA study material, is on this. Then coming to reserves and surplus, the most important part. Reserves and surplus of holding company will go to consolidated balance sheet. Reserves and surplus of holding company will go to consolidated balance sheet. However, you need to be remembering couple of adjustments. First one is post acquisition dividend. If in case the subsidiary company declares any dividend, such dividend can be classified into two ways. One, post acquisition and pre acquisition. If the dividend is declared out of the post acquisition profits of subsidiary, that becomes post acquisition dividend that should be included in holding company's reserves and surplus. However, if such dividend is pre acquisition dividend, that should not be taken to reserves and surplus of holding. That should be deducted against the book value of investment which is there on the asset side of the holding company, which is investment in subsidiary. That should be done, and only then it will take it to cost of control. Then second adjustment is unrealized profit. If the holding company has sold goods to subsidiary and such goods sold by holding to subsidiary is not sold by subsidiary to outsiders. Holding has sold goods to subsidiary, subsidiary has not sold goods to outsiders. Such inventory is remaining with subsidiary. On that, holding company has booked profit. In standalone balance sheets of holding and subsidiary, no problem. In consolidated balance sheet, such profit should not be recorded. We eliminate that profit from the stock of subsidiary. We'll eliminate that profit from the profit of holding. So this is called downstream transaction. In a downstream transaction where holding has sold goods to subsidiary, subsidiary has not sold it to outsiders, and on such remaining stock, profit element booked by the holding should be eliminated by deducting its reserves and surplus. Talking about other points to remember, if there is any pre-acquisition dividend, it should be adjusted against cost, not included in reserves and surplus. Post-acquisition dividend to be included in reserves and surplus. Unrealized profit, goods sold by holding to subsidiary on downward, If remaining unsold, then profit to be reduced from reserves and surplus. Coming to subsidiaries. Subsidiaries profit will belong to both holding company and minority. So split subsidiaries profit or subsidiaries reserves, any number of reserves given, into two categories, pre and post. How do we bifurcate? It is the line that we draw called as date of acquisition. As on the date of acquisition, whatever profits and reserves are there in subsidiary are pre. Whatever profits are there in the subsidiary after the date of acquisition are post. To do this, remember, if in case the acquisition is in the middle of the year, always assume that the profits are evenly spread over the period. And this, whatever is shared as pre and post, is shared between holding and minority in the percentage that we computed here. Whatever the percentage that we computed here in shareholding, in that percentage we will share the pre and post acquisition reserves between holding and minority. Now coming to important points to remember when it comes to reserves of subsidiary. First one, like I mentioned, if the acquisition is in the middle, assume the profits to be evenly spread. You can divide it based on months. Revaluation. Whenever the subsidiaries assets are revalued on the date of acquisition, then if we should check whether the revaluation is upward or downward. If the revaluation is upward, assets go up, credit is revaluation reserve, which is surplus. If the revaluation of the assets is downward, then there is deficit. Basically, revaluation reserve will be negative. Don't apply accounting standard 10 here, saying that upward revaluation is revaluation reserve, downward revaluation is P&L. No, whether it is upward or downward, it is revaluation reserve. If the assets are revalued upward, revaluation reserve credit, positive number. If the assets are revalued downward, revaluation reserve is negative. And this debit or credit, surplus or deficit, is always pre-acquisition profits. Revaluation arising on reserve arising on revaluation of assets of subsidiary is always pre, because revaluation is happening on the date of acquisition, not on date of consolidation, date of acquisition. And continuation of this, on this revalued portion we need to compute depreciation. Previously they would have computed depreciation on pre-revaluation asset, old value of the asset they would have computed depreciation, but depreciation should be charged on the revalued portion. When we revise this depreciation, that excess depreciation to be charged on upward revaluation, or depreciation which is excessively charged to be reversed on downward revaluation, will be always post. Simple trick, don't break your head. Upward revaluation portion, on that amount compute depreciation. That upward, now you did upward, no, charge the depreciation by deducting from post acquisition profits. When you do downward revaluation, you are reducing the value of the asset. Previously value of the asset would be more depreciation would have been already charged. Now that extent of decrease is there, no, on that element of decrease you compute depreciation, that you should basically add back to your post acquisition profits. Remember, revaluation always pre, depreciation on revaluation always post. Then bonus issue. Whenever the subsidiary company makes bonus issue after the date of acquisition, before the consolidation date, we know how to adjust it with share capital. But share capital will increase by decrease in reserves. That decrease in reserves should be always pre, not post. Only when the pre-acquisition reserves are completely exhausted, then we can take the post-acquisition. I hope you remember the order of reserves that should be considered. CRR, security premium, capital reserve, general reserve, then P&L. When you come to these reserves, any of the reserves when you're taking, utilize their pre-portion first before you touch the post-acquisition reserves of that. And if the accounting policies followed by the holding company and subsidiary company are different, subsidiary company's accounting policies should be changed to give the same accounting policy what the holding company is following. Whenever you do this, you need to adjust the profit up to the date of acquisition, and up to the date of acquisition, when you change that accounting policy, whatever impact on profit arising is to be adjusted with pre. After the date of acquisition till the date of consolidation, when you change that accounting policy, whatever reserve change arising should be adjusted with post. And dividend, if the dividend is given out of pre-acquisition profits, it is pre. If dividend is given out of post-acquisition profits, it is post. The question should mention. If they don't mention, we can assume it to be pre and then deduct it from the old profits. Even if the question does not specifically mention, whenever there are preference dividends, assume that the company is declaring dividend and deduct it from reserves and also make the payment. Are you getting it? That's with regard to cumulative preference shares. By this we are done with our reserve part, which is the most important part. Then comes long-term borrowings, which is debentures. If there is any long-term borrowings, which is debentures, in the holding company's books, that will straight away appear in consolidated balance sheet. No problem. However, if it is there in subsidiary, then you need to check, does any part of that subsidiary's debentures represent investment by holding? If holding company holds it, treat it exactly like share capital. Split that subsidiary's long-term borrowings into two categories: held by holding company, held by others. Others is not minority interest. Others you post it to balance sheet, consolidated balance sheet, others. However, if it is held by holding company, you need to take the nominal value of that investment, which will come from your liability side of subsidiary company's balance sheet. You compare it with the investment which is there in the holding company's asset side. You take the difference. Asset, investment, holding company's balance sheet, liability, nominal value, subsidiary's balance sheet. If the asset value is more, liability is less, goodwill. If the asset value is less, liability is more, capital reserve. This will be treated on par with our cost of control. So what is cost of control arising in share capital treatment and this long-term debenture treatment together should be taken as net capital reserve or goodwill and should be posted to consolidated balance sheet. Next we have with us payables and receivables. If there is any trade payables, trade receivables, bills receivable, bills payable, if it is of holding or of subsidiary, add them together and post it to consolidated balance sheet. What should we be posting? Holding, subsidiary together into consolidated balance sheet. However, if any part of it represents holding to subsidiary or subsidiary to holding, receivable to holding, payable to subsidiary, or receivable to subsidiary, payable to holding, that should be eliminated from both holdings as well as subsidiaries, from receivable as well as payable. This is only in consolidated balance sheet, not in standalone. Important thing with regard to bills of exchange. If there is any bills of exchange between holding and subsidiary, let's say holding has given bills of exchange to subsidiary. Subsidiary has got these bills discounted or subsidiary has endorsed these bills. To the extent bills are not there with subsidiary, don't treat it as mutual indebtedness. Mutual indebtedness is whichever is less among both the companies. A limited, okay, holding company says 10,000 bills receivable from B. B limited says 8,000 bills payable to holding. Then only 8,000 will be eliminated in both the places. Those 2,000 rupees worth of bills or something which is discounted or endorsed is a liability in consolidated balance sheet. Next, with regard to PPE, I already told you PPE, holdings PPE, subsidiaries PPE, we add them together and then write. Subsidiaries PPE can be revalued on the date of acquisition. If it is upward revaluation, add. If it is downward revaluation, deduct. On that revalued portion, depreciation has to be adjusted. On that revalued portion, you should deduct depreciation. If it is upward, if it is downward, on that revalued portion, depreciation should be added back. Remember to do this depreciation adjustment from the date of acquisition till the year end. Date of acquisition need not be beginning of the year in all the cases. May 2024 examination question, date of acquisition is in the middle. So depreciation should be computed for half the year. So check that question as well. Let's go to investment. Investment in the asset side of the balance sheet of holding company. So basically, if there is any investment, holdings investment, subsidiaries investment, we add it together and then write. If the holding company's investment represents investment in subsidiary, then that investment should not appear in consolidated balance sheet. What do? That investment in shares is asset. It should be compared with nominal value of investment from subsidiary share capital. That is basically cost of control. If asset is more, goodwill. If liability is more, goodwill, capital reserve. Liability is nominal value of share capital from subsidiary's balance sheet. Asset is investment from holding company's balance sheet. Understood that? And in this, we have to remember two important things. One, whenever bonus issue is made after the date of acquisition, before the date of consolidation, such bonus number of shares should be added to nominal value of investment. And if in case there is any pre-acquisition dividend issued by subsidiary, meaning subsidiary company is declaring dividend out of pre-acquisition profits, it should be deducted from book value of investment held by holding company. And after we analyze the reserves of subsidiary into pre and post, pre-acquisition reserves of subsidiary, to the extent it belongs to holding, that element also should be further deducted from book value of investments. Then comes to inventory. Inventory will take holding and subsidiaries inventory, add them together and write in consolidated balance sheet. If there is some inventory sold by holding to subsidiary or vice versa, and that inventory is remaining unsold in that company, buying company, then on that stock, unrealized profit margin has to be eliminated from the reserves of the selling company, from the inventory of the buying company. Goods sold by holding to subsidiary or vice versa and not sold to outsiders represents unrealized profit on that inventory to the portion left multiplied by profit percentage. Such profit should be eliminated from the reserves of selling company, inventory of buying company. By this we are done with entire thing with regard to balance sheet. Couple of things to notice: always check whenever if the receivable by one company and payable to the other company is not matching. You should remember there might be some error. We need to do reconciliation and rectification. You might have done one question where the interest payable by one company is receivable by the other had not recorded it. We first reconcile, rectify the error, and then do consolidation. And in order to do consolidation, dates should match. Standalone balance sheet of subsidiary, standalone balance sheet of holding, dates should match. If the dates don't match, then update subsidiary's balance sheet till the date of holding and then do consolidation. Then minority interest. Like I mentioned, minority interest represents minority share in reserves, minority share in both pre-reserves, post-reserves, along with the share capital. System all together, it is minority interest. Write them in the consolidated balance sheet on the liability side. After share capital, reserves and surplus, and share application money received pending allotment, before non-current liabilities. Even if the accumulated losses is more and share of minority will become more than its share capital, in that case minority interest cannot become negative. I'll repeat, if the minority share in the losses, pre-acquisition reserves and post-acquisition reserves together, if it becomes more than the share capital of minority, it can become negative, but it should not be shown in balance sheet. Such loss will be borne by holding company. Now we will head into consolidated profit and loss statement. Consolidated profit and loss statement, we need to take revenue as well as purchases, revenue from operations, purchase of stock in trade, everything of holding and subsidiary, put them together and then write. However, if the sale of holding is purchase of subsidiary or vice versa, such an entire transaction amount of total sale value as well as purchase value should be eliminated from the sales of the selling company and purchases of the buying company. It can be either ways, full transaction amount. Then in this case, after this you need to know other income. See, holding company can charge subsidiary company management fee. One of them can pay commission to another. There can be interest payment. There can be dividend payment. All of this. So these items should be eliminated. Other than this, holdings expense, subsidiaries expense. Holdings income, subsidiaries income. We should write them together. Special points is usually watch out for management fee charged by holding to subsidiary. To holding company it will be other income. To subsidiary it will be administration expense. In the consolidated balance sheet, eliminated from administration expense, eliminated from other income. Then commission. If there is any commission paid by holding to subsidiary or subsidiary to holding, eliminated from other income and other expense. Sometimes commission paid will be included in selling and distribution expense of the paying company. Please eliminate it from there. That will become simple. Tax expense. Don't touch anything. Tax of subsidiary, tax of holding, put them together, put it in consolidated PL. Got that? Appropriations. If in case there are any appropriations such like dividend, transfer to reserve, all these items, this is actually not part of consolidated PL. Unfortunately, in some questions that we do, this is given. Remember, dividend given by subsidiary, to the extent it belongs to holding company, should not be written as an appropriation. It should be eliminated from other income of the holding company and payment of dividend from subsidiary company. If it is pre-acquisition, it would be eliminated from the cost of investment of subsidiary holding company, and here you eliminate only the payment part. It will not be included in other income. Let me repeat, if the subsidiary has paid dividend, check whether the dividend is pre or post. If it is post acquisition, it would be included in other income of holding, eliminated there in the income side. Either ways, in the payment, in the appropriation side, eliminate the holding share in the dividend. Only dividend paid by subsidiary to other than holding should be written in that appropriation. Finally, we need to write minority share in that statement of profit or loss of the profits of subsidiary. Don't take consolidated profit multiplied by minority percentage, because minority is interested in profits of subsidiary alone, not of holding and subsidiary together. And we should not take the percentage of profit of subsidiary after making all these adjustments. Take standalone profit and loss of subsidiary. In that standalone profit and loss of subsidiary, before making any adjustments for this consolidation, before eliminating any intercompany transactions, whatever is the profit, on that profit minority share will be multiplied. That has to be deducted from the appropriation. And if that standalone P&L is given, good. If not, in certain questions you might have to prepare that standalone P&L to determine minority share in the reserves or profits of subsidiary. Once you deduct that, whatever remains at the bottom of your consolidated PL is a reserves, which is revenue reserves to be transferred to holding company's consolidated balance sheet. I hope you understood.